So you can sort of pick the area of the market you want to pick on because there's a lot of places to look at.
So I've been in the camp that this is seasonal and is what you should expect in the month of August. And I have a million charts that back that up. And I'm not ready to move away from that argument. If things get materially worse, I may be forced to rethink that. I do not think that this is about all of a sudden there's going to be this renewed push for a ton of new rate hikes. And in fact, most people, you ask them what's going on in the market this month, why did August suck so much? They'll tell you, oh, well, the odds of the rate increase are substantially higher. No, they actually aren't. Actually, it's a 90% chance of no hike and a 10% chance of a 25 basis point hike, and that would be okay. I don't think that that is a huge difference. Now, we do have some positioning stuff going on, and a lot of the macro people will tell you, look at yields all over the world. They're higher. Okay. It's a steepening. It's what you should have. If GDP now forecasts are to be believed, we're going to have another quarter of strong growth. Why wouldn't we have more steepening? So for me, that's enough. One area of concern, and I'd love to get Belski's take, maybe 7.25 is too high for 30-year mortgages. Like maybe that's where things get real. And the sell-off in home builders yesterday was probably the proximate cause for that was probably that mortgage number. Maybe that's where I have the most concern. How much higher can that go before something gets hurt? But other than that, I'm just not seeing what other people are seeing. And I think this is a textbook August doldrum kind of pullback.
Yeah. Brian, the correction thus far, S&P is down about 5.5%. I thought Goldman's Tony Pasquarello sort of set the scene well in his most recent note where he says, quote, liquidity is ebbing, price action skittish, and tactical nerves are suddenly a bit frayed. That pretty much sums it up.
I love ebbing, right? I mean, Josh and I were talking beforehand, and you go back and look at my career, and August is always something going on. And remember, last year was very, very volatile heading into September. And so we're not surprised to see this weekend. We've been talking this weakness. We've been talking about this for quite some time. And you talk about the home builders, Josh. I mean, I think people forget that home builders actually were one of the best performing industries after tech. So this could simply be some profit taking, number one. But number two, that 7% number on mortgages does freak some people out. But remember, also from a supply standpoint, you got a lot of supply coming in the home builders. So I think that's an area that you want to start with these types of reactions on stocks that have been outperforming, Scott. You want to try to make a list of some of these things to bottom fish a little bit in September.
So you bumped your target on the S&P up on June 5th,
yeah,
right, from 4,300 to 4,550. At what point do you start getting a little nervous about 4,550, just given the unsettled nature of where we're at? And also seasonally, as you said,
yeah,
September, October could be a little tough.
September, October could be a little tough. I'm actually more worried that 45.50 might be too low because I think the way earnings are coming in, Scott. So the way that earnings are tracking, I think there's a very good shot that we make it to our bull case of 230, and I think that could ultimately buoy stocks higher in October, November, December. Remember, September. We're more back to normal than we have been the last few years. And September's conference season. We're going out and visiting companies. We're talking to companies. This has been the bottoms-up stock picking type market this year, and this is all about fundamental stock picking. So I do think we're going to see some sort of a rebound and really strong fourth quarter, which actually get us closer to the 50-50 level.
But you know what's not back to normal? It's sort of back to abnormal is China. Right, yeah. And that's this overhang that we're trying to assess. The recovery was sluggish, and now it looks like a deceleration in growth there. And, where the market was able to brush that off for a while, seems like it's having a harder time doing so now.
I think from a growth perspective, that's why I think Josh is spot on with respect to the potential for further rate increases. If China is actually going to be really slowing like everybody thinks it is, then the Fed may have to think the opposite direction, number one. Number two, remember, emerging markets in China did very well last year. So this could also be part of the unwind on that side. But there's no doubt that there's massive fundamental and macro issues in China that we've been avoiding.
Yeah, so Carrie, Michael Hartnett over at Bank of America sort of sees this swoon, if you will, through the summer. Maybe you go to 4,200 late summer. But there are others who say, okay, and I think Brian is channeling this point of view as well, that even if you have some selling here and some profit taking in tech, that you get through the fall and it could be a little ugly like it typically is. And then you have a ramp, though. And you have a ramp into the end of the year that can still get you to some nice targets.
Well, That would be quite a swoon if we go to 4,200, and we're not thinking that's going to happen. I suspect that people will start to take the opportunity with some of the tech names that they've missed to begin to nibble. It's interesting that it's a Friday in mid-August. The market opens down. A lot of Fridays when the market is down after a bad Thursday, that continues and it accelerates into the day. What's happened so far today is that we're seeing a settling down and people are coming in and buying.